Hello, friends. If you are 65 or older and you move retirement money, cash, gifts, or savings through a bank, there are 8 account moves the IRS and Treasury are flagging in 2026, and most people making them have no idea a report follows. The move itself may be perfectly legal. The report may be automatic. What can destroy you is that nobody stops to explain what form follows the money, or what happens when you get it wrong. On one of these, a foreign account rule most people have never heard of, the taxpayer advocate has illustrated a statutory maximum penalty exposure of over $600,000 on a $25,000 account. That is not a typo. And it is not the only one on this list that carries real consequences. Hello, friends. Grab a pen because the next 20 minutes are not tax theory. They are 8 ordinary account moves: cash, transfers, app payments, retirement withdrawals, CDs, gifts, and foreign wires that create government reports, tax forms, or penalties if you handle them the wrong way. Some of these apply to you right now. At least one of them is yours. And for each one, I am going to tell you what gets flagged, what the government actually receives, and the correct way to handle it so you stay clean. Mark the ones that apply to you as we go. Now, before we get into the list, I want to make sure you are not missing content like this, because this stuff changes. Thresholds change, forms change, outdated money rules travel fast and stick around long after the real number has moved. The people subscribed to this channel find out in time. If that sounds useful to you, subscribe now and let's get into it. Before we go further, I need to address something, because people hear a topic like this and immediately sort themselves into one of 2 groups. The first group is comfortable. You have savings, maybe a few accounts, CDs, possibly even some ties overseas, and you assume these warnings are for people doing something shady. That is not me. The second group is on a fixed income. You count every dollar. You use cash, you help family, you sell household items, and you have learned to assume the bad surprises always land on somebody else. Both of those assumptions are wrong on at least one item today. On every single one, I will tell you exactly which group it helps most and how. And stay until the end, because the last one is the item people dismiss as international paperwork, until they find out a modest foreign account can sit inside a 6-figure penalty structure that the taxpayer advocate has put on paper. Let's go. Number 1. Cash deposits or withdrawals over $10,000. Here is the misconception. Most people believe that if the cash is legal, nothing gets reported. That is not how this works. When you walk into a bank and deposit or withdraw more than $10,000 in currency, cash or coin, the bank files what is called a CTR, a currency transaction report, with a federal agency called FinCEN. That is the Financial Crimes Enforcement Network under the Treasury Department. The report goes in whether or not you did anything wrong. It is not an accusation. It is an automatic filing. And here is the part most people miss. If you make 2 smaller cash transactions on the same day that add up to more than $10,000, those get aggregated. A $6,000 deposit in the morning and a $5,000 deposit that afternoon reach $11,000, and the report still goes in. This one helps the fixed income group most. Seniors who still handle a lot of cash from a home sale, an estate distribution, years of savings, often assume cash reports are for businesses or criminals. They are not. They apply to ordinary people handling legal money. One cash day at $10,001 gets the report. 2 smaller cash moves the same day at $6,000 and $5,000 get there too. Here is your action step. Before a large cash deposit or withdrawal, keep the source of funds paper trail ready. A sale receipt, a bank statement showing where the cash came from. Walk in and say, "This is legal cash from my own funds, and here is the paper trail showing where it came from." No separate form to file on your end. The bank handles the CTR. You handle the documentation. That is number 1. That is the warm-up. The next one is what people do when they think they are being clever, and it can be worse than the deposit itself. Number 2. Multiple cash transactions just under $10,000. The misconception here is dangerous. People hear the $10,000 rule and think the smart move is to stay under it. Break that $15,000 into 2 trips. Keep each one at $9,900. That feels safe. It is not safe. It is the thing that can turn a legal deposit into a federal problem. The conduct is called structuring, breaking up cash transactions in a pattern designed to dodge the reporting requirement. And structuring is a crime, even when the money itself is perfectly legal. FinCEN's own customer guidance says the penalty can reach up to $250,000 in fines, up to 5 years in prison, or both. This one helps both groups. The fixed income viewer does it out of fear. I do not want the government looking at me. The comfortable viewer does it out of habit or a sense of privacy. Both are making the same mistake. 3 deposits of $9,900 do not make you safer. If the pattern was built to dodge the report, that is the conduct that creates the exposure. Your action step. Do not split cash transactions to stay under a number. Handle it as one documented transaction. Walk in and say, I am not trying to stay under any limit. I want to handle this as one documented transaction. That is number 2. And it does not stop with cash. The same kind of suspicion can follow patterns that never touch a stack of bills. Number 3. Rapid transfers among multiple accounts or banks. The misconception is, it is all my money, so the pattern does not matter. It can matter. When a bank sees a series of transfers that look unusual, fast movements between accounts, round number wires bouncing between institutions, they may file what is called a SAR, a suspicious activity report. That goes to FinCEN too, quietly, without telling you. The threshold here is not a giant number. Banks report suspicious transactions generally involving or aggregating $5,000 or more. And the bank has 30 days from detection to file, up to 60 if no suspect has been identified yet. But here is the key. A FinCEN FAQ from 2025 says that activity merely near the CTR threshold does not automatically require a SAR without actual indications of evasion. Context matters. Documentation matters. This one helps the comfortable group most. The retiree with multiple banks, a brokerage, a money market, moving funds around, who assumes it is all mine, so none of this matters. A $5,000 pattern the bank cannot make sense of is enough to trigger a filing. Your action step. If you are moving money among your own accounts, keep one clean written trail explaining the purpose and the source. Call the bank or your brokerage service desk and say, these are transfers among my own accounts. Here is the source of funds and the reason for the movement. That is number 3. Now let's move from banks to the screens in your hand, because one of the loudest tax myths in America is sitting right there. Number 4, large Venmo or PayPal goods and services payments, and the Zelle myth. The misconception goes like this. Anything over $600 on any payment app goes straight to the IRS. That number is wrong. That rule is outdated. And for one major platform, no amount triggers the form at all. Here is how it actually works. For third-party settlement organizations, that means platforms like Venmo for Business and PayPal Goods and Services, the federal reporting threshold for 2026 is over $20,000 and more than 200 transactions, not $600. That old number got talked about for years, but it is not the current federal rule. And personal gifts and reimbursements are not the same as payments for goods or services. Now here is the part that surprises people. Zelle does not issue 1099K forms and does not report Zelle network transactions to the IRS, even over $600. Zelle operates differently. That does not mean income sent through Zelle is not taxable. Taxable income is taxable regardless of the platform. but Zelle itself is not generating the form. This helps both groups with a fixed income surprise. The senior who sells household items, collects reimbursements from a neighbor, or does a small side job through an app needs to know the real threshold, not the myth. Over $20,000 and more than 200 goods and services transactions. That is the federal 1099K line. Below that, no federal form from the platform, but the income is still taxable if it is income. Your action step. Separate personal reimbursements from goods and services activity in the app itself, and review any 1099K you receive against your own records. If something is wrong, go to irs.gov/1099K or irs.gov/1099K help. That is number 4. So far, this has been about who sees the money. This next one is about who gets paid first, and it can quietly change what you owe. Number 5, a large IRA distribution with too little withholding. Now, everything I have covered so far is about visibility, reports, flags, forms that follow the money. I need you to hear this one carefully, because this is not just visibility. This is a transaction that can create a real tax bill even when nobody accuses you of doing anything wrong. The danger here is a default setting you probably never changed. When you take a non-periodic distribution from a traditional IRA, the custodian uses Form W-4R to set your withholding. The default rate is 10%, and the IRS itself warns that the default may be too low for your actual tax situation. A viewer wrote in about this after taking a large IRA withdrawal. His name was Robert, 72, retired machinist outside Tulsa, Oklahoma. He took a $60,000 taxable IRA distribution to cover a roof replacement and some medical bills. He left the account at the default 10% withholding. At 10%, $6,000 went to the IRS. If he had elected 22% on the W-4R, $13,200 would have gone in. That is a $7,200 prepayment gap the default setting left behind. Robert did not owe a penalty that year by luck, but he was one estimate short of one. He changed the election with Form W-4R before his next withdrawal. This helps both groups. Anyone taking a large distribution can get hit, but the gap is biggest when the withdrawal is large enough to push you into a higher bracket, and the default 10% barely covers half. On a $60,000 withdrawal, default withholding sends $6,000. A 22% election sends $13,200. That is $7,200 more headed to the IRS before April, not after. And if you do not pay enough through withholding or estimated payments, you may owe an underpayment penalty. The IRS says most people avoid that penalty if they owe less than $1,000 after withholding and credits, or if they paid at least 90% of the current year's tax, or 100% of the prior year's tax, 110% for higher income filers. Your action step. Before a large IRA distribution, set the withholding on Form W-4R. You can find it at irs.gov/W4R. If the money has already come out and the withholding was too low, make an estimated payment using Form 1040-ES at irs.gov/Form 1040-ES. The 2026 estimated tax dates are April 15th, June 15th, September 15th, 2026, and January 15th, 2027. Use the exact words with your custodian. I am taking a taxable IRA distribution. I want federal withholding set at 22%, and I want the election recorded on Form W-4R before the money leaves. That is number 5. That one can create a bill. The next one creates a form people misread every single year. Number 6. Breaking a CD early and misreading the year-end form. The misconception sounds reasonable. You broke the CD, the bank charged you a penalty, so the interest number on the year-end form must already be reduced. It is not. The bank reports the full interest. The penalty is not subtracted. You have to handle them as two separate lines, and most people do not. Here is how it works. If you withdraw from a deferred interest account before maturity, the IRS says you must report the full interest earned without subtracting the early withdrawal penalty first. That penalty becomes a separate deduction from gross income. The documentation shows up on Form 1099-INT or Form 1099-OID, depending on the account type. A woman I heard from after breaking a CD learned this the hard way. Her name was Elaine, 69, retired school secretary outside Dayton, Ohio. She broke a CD early, and her year-end form showed $12,400 in interest and a $1,600 early withdrawal penalty. She almost reported only the net, $10,800. That would have been wrong. She needed to report the full $12,400 as interest and then claim the $1,600 penalty as a separate deduction. At a 22% marginal federal rate, missing that $1,600 deduction costs roughly $352 in unnecessary tax. That is not a fortune, but it is money she earned the right to keep, and the form was not going to explain it to her. Here is the part where the comfortable retiree usually tunes out, and you should not. This is the CD-heavy saver, the person who thinks of themselves as conservative, not high risk. You are exactly the person most likely to mishandle this form because you assume a simple savings product means simple paperwork. The bank reports the full $12,400. The penalty does not erase that interest. It becomes a separate deduction, and at a 22% bracket, missing a $1,600 deduction costs about $352. Your action step. Before you file, match the year-end interest form to your return. Look for both numbers, the full interest and any early withdrawal penalty, and make sure the penalty is claimed separately. Call your bank's year-end tax reporting desk and say, "Please show me the interest reported and any early withdrawal penalty on the year-end form." File by your annual return deadline. That is number 6. And then there is the money that hits your account and is not income at all, but still scares people into mistakes. Number 7. Receiving a large gift deposit without documentation. The misconception here creates more unnecessary panic than almost any other item on this list. A large sum lands in your bank account from a family member and you think, "Do I owe tax on this?" In most standard domestic gift situations, the answer is no. The recipient of a true gift generally does not owe income tax on it. The IRS says so directly. But here is where it gets misunderstood. The reporting duty, when it exists, usually belongs to the donor, the person who gave the money, not the person who received it. For 2025 and 2026, the annual gift tax exclusion is $19,000 per donor per recipient. That means one person can give you up to $19,000 in a year with zero reporting obligation on either side. If the gift goes over that amount, the donor, not you, may need to file Form 709 by April 15th of the following year. This helps both groups. Family gift transfers happen at every income level, and the panic almost always lands on the wrong person, the recipient, when the reporting duty, if any, belongs to the giver. A $25,000 gift is not $6,000 of taxable income to the person who received it. It is $6,000 over the annual exclusion for the donor's reporting calculation. The recipient does not file Form 709. The donor does if the total to that one person exceeds $19,000 in the year. Nobody at the bank is going to explain this split to you. The deposit hits your account, you see a large number, and the system leaves it to you to understand who owes what to whom. Your action step. Keep a simple gift letter and a transfer record showing the date, the amount, the donor, the recipient, and the fact that it was a gift, not income. Confirm whether the donor needs to file Form 709 at irs.gov/Form 709. Use these words. This deposit was a gift, not income. I want to document that clearly, and I want to know whether the donor needs Form 709. The deadline for the donor, if the form is required, is April 15th of the year following the gift. That is number 7. If you thought family money causes panic, wait until you hear what happens when the account is outside the country. Number 8. Large wire transfers tied to foreign accounts. This is the one I told you to stay for, and the misconception is the most expensive on the list. That is offshore stuff. It has nothing to do with me. It has everything to do with you if you have a bank account, an investment account, or even certain pension rights in another country. And that includes accounts you opened decades ago, accounts you barely use, and accounts you may have inherited. The rule is called the FBAR, the Foreign Bank Account Report. In plain English, if you are a U.S. person and the combined value of your foreign financial accounts exceeds $10,000 at any time during the calendar year, you must file FinCEN Form 114 with the Treasury Department. The deadline is April 15th, with an automatic extension to October 15th. There is a separate IRS form, Form 8938, that kicks in at higher thresholds. For a single filer living in the United States, that one starts above $50,000 at year-end or $75,000 at any point during the year. The IRS says you may need to file both. Now here is the number that should make you stop. The willful penalty for not filing the FBAR can be the greater of $100,000 or 50% of the account balance at the time of the violation. The taxpayer advocate has illustrated what that looks like in practice. On a modest $25,000 foreign account, a willful non-filing case sitting inside a 6-year look-back period can produce a statutory maximum exposure of over $600,000. That is not typical. That is not automatic. But it is the framework that exists if the government treats the failure as willful. This helps the comfortable group most and hardest. The retiree with a legacy account in the UK, a small savings account in Canada, family money in the Philippines, an old pension in Germany. You are exactly the person who assumes this rule is for offshore operators hiding money. It is not. It is for anyone with a foreign financial account above the threshold. A $10,001 aggregate foreign account value triggers the FBAR. Over $600,000 is the illustrative statutory maximum exposure the taxpayer advocate has put on paper in a willful case. The wire transfer is the red flag for review, but the real obligation is about the account relationship and the value, not one single transfer. Your action step. Check whether you need the FBAR, Form 8938, or both. File the FBAR electronically at bsaefiling.fincen.treas.gov. Check Form 8938 requirements at irs.gov/Form 8938. And say these words to your tax preparer. I have foreign accounts and I want to confirm whether I need FinCEN 114, Form 8938, or both. The FBAR deadline is April 15th with an automatic extension to October 15th. That is number 8. So here is the full picture. 8 account moves, 8 reports or forms or penalties that follow the money. The cash day over $10,000 that triggers the CTR. Keep your source of funds records before you walk in. The smaller deposits that become structuring if the pattern was built to dodge the rule. Do it once, document it once. The rapid transfers among your own accounts that can still look suspicious without a paper trail. One written reason, one clean record. The payment app myth, where the real federal 1099K line is over $20,000 and more than 200 transactions, and Zelle is a different animal entirely. Separate your reimbursements from your business activity. The IRA withdrawal, where the default 10% withholding can leave you short. Set the W-4R before the money leaves. The CD form that reports full interest and expects you to claim the penalty separately. Match the form before you file. The gift deposit that is usually not income to the recipient but may still need donor reporting on Form 709. Keep a gift letter and know which side the duty falls on. And the foreign account rule that can carry the biggest stakes of all. Check FBAR and Form 8938 together and do it before the deadline. That is the list, and every single one of these has something in common. The bank does not stop and teach you the CTR rule. The teller does not protect you from structuring. The fraud system does not explain ASAR to you. The payment app does not sort your tax records for you. The IRA custodian does not know your real tax bracket. The bank does not file your deduction for a broken CD. Your family member does not automatically handle the gift paperwork correctly. And Treasury does not waive a foreign account rule because you did not know it was yours. Being allowed to move your money and understanding the reporting rules attached to that money are two completely different things. The gap between them is information, and that is exactly why this channel exists. Now here's what I need from you. Think of one person, a parent, a neighbor, a sibling, or a friend from church who is over 65 and still handles cash, CDs, IRA withdrawals, or family transfers. Not because they are doing anything wrong, because the odds are good they are doing at least one of these 8 things without knowing what report or form follows it. Send them this video. You do not have to explain it, just send it. That is the whole ask. Subscribe, share this with someone you know who moves money through a bank and does not know what gets reported, and I'll see you in the next one.